I said it once and I'm going to say it again. It don't matter how much money you make, it's all about how much you keep. The goal of the game is to keep as much money of yours as possible and keep Uncle Sam out of your pockets. In this video, I'm going to break down exactly what tax efficient investing is, why it's important to you, 3 accounts that every entrepreneur should be aware of, and if you stick around to the end, I'll even show you how to create a plan to keep more of your money now and later. Now let's start by addressing the elephant in the room. What the hell is tax efficient investing, and why does it matter to you as a business owner? And like Uncle Ben said to Peter Parker, with great power comes great responsibility. And one of the unfortunate downsides of being an entrepreneur is that you do not have a job sponsored 401k or a pension. When it comes to saving for retirement, that is your responsibility and your responsibility only. Through the lifetime of your business, if your sole focus is only on scaling, growing revenue, and making more money, you could be missing out on thousands if you don't understand how taxes impact your long-term wealth. So let me give you an example. Imagine your business generates $100,000 in profits this year. Without a plan, you're going to get taxed on every dollar. But if you took 20 out of that 100,000 and invested it into a tax advantage retirement account, you're decreasing your taxable income, paying less tax today, but you're also putting your money to work for the future. Listen, the number one rule to the game is keeping as much money as possible. Understand, Uncle Sam is gonna get his, but you have control over how much it is that he has access to. To invest tax efficiently, you gotta understand these 3 buckets: your pre-tax, your tax-free, and your taxable accounts. Number 1 is your pre-tax account. This is also referred to as a tax-deferred retirement account. The benefit of this account is that it reduces your taxable income today, but the downside is you're still going to have to pay taxes on that money later on down the line in retirement when you go to withdraw from that account. For the self-employed out there, examples of these accounts are a SEP IRA or a solo 401k. Think about it like this. You're planting seeds today without having to pay for them. But understand, in retirement, when those fruit go to bloom and you go to reap the fruits of your labor, Uncle Sam's going to get him a slice. Next is your post-tax account or your tax-free account. With this account, you pay taxes on the money you contribute now, but this money also grows tax-free over time, and in retirement, you get to withdraw it or you get to take that money out and not have to pay Uncle Sam a dime. An example of these accounts for self-employed are a Roth IRA or a Roth Solo 401k. The benefit of using this account is if you're in a lower tax bracket today, but you expect to make a lot more money and to be in a higher tax bracket later on in life, then you're essentially getting a discount on your taxes today so that you don't have to pay any later on. Using the same analogy, it's like paying for your seeds now, and when you go to reap the fruits of your labor in retirement, it's all yours tax-free. You either pay now and you get a discount up front, or you pay later, and honestly, I can't tell you how high taxes are going to be in the future when it's time for you to retire. So your best bet is to get the discount now. And the last account is a taxable account, which is also referred to as a brokerage account. Now with a brokerage account, there are no tax breaks, but the upside is you do have the flexibility and access to your money at any time. Now this account is like planting a fruit tree, but you're going to pay a small tax every year on all the fruit that it produces. So now that you're aware of the 3 buckets, let's talk about how to combine them into a plan that saves you money, not just today, but also in the future. Step 1 is you have to prioritize the tax advantage accounts. You want to start with the tax deferred accounts like a SEP IRA or a solo 401k so that you can decrease your taxable income today and invest that money for the future. Step 2, maximize tax-free growth with your Roth accounts. Listen, you want to mix in some Roth contributions into your portfolio because you want some tax-free money in retirement. And 3, invest your excess profits into taxable accounts. Once you've maxed out your tax advantage retirement accounts, you can invest any additional capital you have into a brokerage account using a low-cost investment strategy. This is where you can store your cash reserves, your emergency fund, or even your capital that you're using to reinvest. Step 4, plan for future required minimum distributions. In retirement at age 73, the IRS requires you to take a portion of your pre-tax accounts every year, and it's then taxed as income. So if throughout your career you only took advantage of the pre-tax accounts, then you could potentially push yourself into a higher tax bracket in retirement. Having a mix of pre-tax, tax-free, and taxable accounts will allow you to have more control over how much you withdraw in retirement as well as how much you pay in taxes. You can save on taxes now, minimize your tax burden in retirement, and grow your wealth faster. See y'all next time.